Greetings and welcome to KBRA Podcast. I am Joan Feldbaum-Vidra, Head of Sovereigns for KBRA, and with me here is Ethan Heisler, Editor of KBRA's Bank Treasury Newsletter. We are here to discuss the topic of the day, inflation and rates. The title of this podcast, NIRP, Dead or in Hibernation, needs a bit of explanation. So Ethan and I authored a piece, sometime in the middle of COVID, on negative interest rate policy, NIRP. And a lot has happened since we laid the groundwork for that piece. So Ethan, kindly update us and please bring us forward to the current and very different dynamics in today's market.
Hey, Joan. Well, Joan, as you remember, about a year and a half ago, which was about 10 centuries ago in pandemic time, we actually envisioned that, low rates were going to be with us forever. And that everybody, all countries, all sovereigns were going to be sucked down into this negative interest rates because the ceiling on interest rates was very low at that point. And there was a
with the Bank of England, right, leading the pack.
Right, but there was a lot of speculation about the U.S. and whether the U.S. could follow suit. And there was still a lot of doubt about that. Certainly when the 10-year was at 50 basis points, there was a lot of doubt about that. But, the Fed continued to insist that negative rates was not a policy option. And that piece, as you remember, we talked a lot about why that was not a policy option for them. Because you can ask me why that was. Well, as we said, it was not a policy option for the Fed because the Fed could not pay negative interest rates on reserve balances. As we remember, that was a piece of legislation that we talked about in the piece. And whereas in the ECB, Bank of England, none of those central banks, the Japanese central bank, none of those were bound by the same legislation that set the overnight rate with the Fed. So if you can't lower your overnight rate below zero, how were you ever going to be able to control the rest of the Treasury curve? It seemed very unlikely. So that was an important argument.
Right. So let's contrast what is NIRP with what's going on in the markets. NIRP is a policy tool. There's a deviation between a policy tool and market.
Right. Well, we're back to where we were 40 years ago at this point, at least by judging by the CPI numbers. So let me ask you a question, Joan. Can I ask you a question?
Yeah.
What do European sovereigns look like from an inflation standpoint right now, and how do they compare and contrast to the U.S.? Let's start with that question.
Okay, sure. We can talk about Europe, but we can also talk about
where are we now versus because as I remember in the piece we were talking about, inflation was struggling to just get above zero, right? They were struggling to keep below deflation or keep above deflation. Where are we now?
Okay, not quite. So in Europe, and we're talking about here the ECB, right? We're talking about ECB economies in the Euro area bloc. I wouldn't say they were struggling to keep above zero. I would say they were struggling to make their inflation target, which was 2%. Okay, and they have a negative. There's a negative interest rate on deposits in by the ECB, right?
Right. Is that still in place now?
Yeah, that's still in place now. And in fact, going into COVID, they didn't move on that, right? They didn't move on that. They just amped up QE a lot more than we did here, actually. The balance sheet of the ECB is a lot bigger. They had an over-reliance on QE because of that interest rate policy. It was being with the negative rate, being very difficult to lower even.
Right.
Whereas the Fed obviously dropped rates. But when you ask me about what's going on right now, the whole globe is experiencing an inflationary impulse. Even in Japan, you see it, okay, where we have a deflation. That's where we've had a deflation threat. So, but in the Euro area, first of all, I should note that there's a divergence among countries. You have different inflation performance, but overall, it's not the same as what we're seeing here in the US. It's lower. Let's say it's about 5. I think the most recent data point was a 5% CPI, whereas we're well over 7% right now, thanks to the news from yesterday. And also another point of divergence is, we're all dealing with the same supply chain issues. That's ubiquitous across the globe. But there's a slightly different situation on the ground with the labor markets. The labor markets are, in a way, it's healthier than what we're witnessing here in the US, because here in the US,
That's an amazing thing to say right in and of itself. I've never heard anybody expect to say that.
Yeah, it's amazing. Yeah.
Well, why do you say that? Well, what makes them better?
Okay, so I'm going to hedge that better. They have their own issues, of course. We all have issues. Everybody has issues, right? But here in the United States, we haven't recouped the employment levels from pre-crisis. We might have a low unemployment rate, and there's a lot of noise in that rate, by the way, and also a lot of noise in the labor force participation rate. But here, when you actually look, what's fueling growth, right? It's employment creation. So if you just look at the raw employment numbers, we're still,
Right.
we're very much lagged. And by the way, this is a situation that's been endemic since the global financial crisis.
Right.
But COVID really led to a mass exit out of the labor force, and we still haven't recovered that. In Europe, it's been much more stable. So here you go. Rigid labor markets actually are serving the country. At this point, they could become more inflationary, of course, because of that. But without being too complicated on this.
But as a consequence of that, the ECB would, I would think, have more freedom to raise rates. Why do you think that they would be more constrained?
Well, wait a second. So I just said that inflation is generally lower and there's a lot of divergence. You have like France on one end, which is in the 2% range, and then, you have, let's say, around 5%. So they can raise rates, and they probably will. They'll probably do it in a sequence similar to what we're doing here, right? But the issue is they actually have more headroom, right? Because you still want to keep rates low, right? You don't want a hard landing.
Right.
But the fact that they're starting from a negative zone, in a way, gives them a little bit more headroom. So we shall see. There's lots going on in Europe, by the way, that we have to remember. It's also, the recovery packages, it could be creating conditions for stronger, more robust growth. And then there'll have to be more reliance on the interest rate to help manage that. I just want to step back a second. I'm sorry, I'm speaking a lot, but remember, the negative interest rate policy in Europe very much also mirrored what was going on with the fiscal policy. You needed to have very tight fiscal policy at that point in time, right? So there was a reliance to get the economy de facto, get the economies moving, the interest rate to moving it down very low to counter the tight fiscal policy. Okay, enough on Europe.
Well, I was going to say, I think in the United States, the fact is, so I think that the Fed is somewhat still constrained on how far it can really raise rates. I mean, obviously, everything kind of seems like it's changing just overnight. Bullard, I think yesterday came out and said that he would raise. He's more inclined to even think. I think that's what he said. He'd be inclined to do a 50 basis points. I mean, you tend to think of Bullard as a real dove from St. Louis. I get a sense that as much as the Fed expects to raise rates, and maybe we're doing 7 hikes this year, 5 hikes, 6 hikes, who knows? I think the Fed's getting very close to what it calls the natural rate of interest, that risk-free rate, which is, maybe our star is like 2%, 2.5%. But I don't think the Fed has as much room to raise that rate as it did in past cycles. What's so interesting about this time around is the size of the Fed's balance sheet. So it's interesting, you said before that the ECB's balance sheet has grown dramatically. I wonder, do you know offhand what's the size of the ECB's balance sheet right now? Because the Fed's is 8.6 trillion, something like that.
So I think the ECB is 50% of GDP. I mean, this is bigger than in relative terms.
Wow.
Yeah.
That's amazing. So it could afford to actually shrink its balance sheet a lot more aggressively and not raise rates. But I think the Fed would be in the same position or is inclined to do the same thing. Its SOMA portfolio, for example, half of it matures under 5 years. So, and they're not planning on selling anything, at least that they've said now, but they can significantly reduce that SOMA portfolio within a very short period of time.
Well, so far in Europe, you have a commitment to continue to reinvest. So I don't expect we'll see a shrinking
Right.
very soon, but this is certainly a policy tool.
Yeah, and I think that's what the Fed has said as well. But what's notable here is that the Fed's flexibility, it seems like all these central banks have a lot more flexibility than just having to raise rates.
A lot more tools in the toolkit.
Right. So, I mean, the sledgehammer response of having to lower interest rates 4 or 5 points like they did in the past, that's no longer really relevant, right? It's kind of interesting.
It is. But Ethan, what if we get back to a 2% rate of inflation more quickly than perhaps factoring in at this stage? What do you
Right.
think about that?
Right. That's the other side of the coin. There's a study out of the Bank of England I wrote about it in my newsletter from November. It goes back, it looks at history of inflation and interest rates for over 800 years. I mean, if those who are listening to this podcast remember the history of interest rates, that also did a whole study that went back to the time of the Babylonians and whatever. But a basic conclusion out of that, and what was also discussed in this study I saw out of the Bank of England, is that the natural rate of interest rates is not double-digit interest rates or even mid-single-digit interest rates like what we saw just 20 years ago. The natural rate of interest rates tends to be around 2.5%. And so we're slowly seeing ourselves move back. We definitely will see ourselves, if history continues the way it has, we will see inflation and we will see interest rates moderate back to that 2%. And if that's the case, if it happens faster, like let's first just give you an example. A lot of car dealers have stocked up on a lot of inventory. A lot of manufacturers, construction, everything else. Everybody's front loading a lot of extra inventory. They did it in the fourth quarter. They may continue to do it this quarter.
Yeah, I just wanted to make sure we emphasize that the fourth quarter, very nice GDP print. That was a story of inventory buildup. That's correct.
So what happens if I come back and it's this quarter, and you know what? The consumer's like, joking. I'm not paying 7.5% inflation. I'm not paying $400 million for the same thing I used to pay just $10 last week. I think that inventory holders only have so much time that they want to hold on to inventory before they start marking it down. And holding inventory right now is a great trade because there's inflation that works in your favor when there's inflation, and interest rates are low. But interest rates are higher and inflation goes away. Oh, now the inventory looks like something I need to mark down. All of a sudden, you have what was marked up, marked down. And that could create a whole change.
Perhaps.
Let's say that Omicron, the future of the next Omicron or whatever it is, subvariant or whatever that we're going to be afflicted with, is really a non-event, or people have stopped worrying about it. And the supply chain issues stop worrying. A lot of cities opening up. Maybe that's, like I said before to you jokingly, maybe the truckers in Canada all go home. Who knows? But the bottom line is that these problems could go all away by the middle of this year, in which case, well, by the summertime, do I expect to pay, $6 for a gallon of gas? Or will it be more like $2.50 for a gallon of gas? I don't know. Could be interesting. We will find out.
Over the long term, for sure. I mean, I think the short term, there's a lot of reasons that this could go in different directions, right? We just don't know. We don't know a lot about the virus. We don't know a lot about how China will modify its zero COVID policy, the weather that's also causing inflationary pressures.
Exactly. We don't know. But for the same, I'm just saying that for the same reason that the economists really missed the persistence of inflation till now, could be for this, their same lack of understanding during COVID times of where inflation is headed and by looking at trends, could be just as frustrated on the other side. That's the point I would make. We don't know, like you said, but it's a good reason why we should probably continue this dialogue.
Yeah. So let's just circle us back to negative interest rates.
Yes.
Anything else to add there, Ethan? I mean, look, overnight, it seems like the volume of negatively yielding paper just has fallen off a cliff.
I'm worried, Joan, about not negative interest rates now. I'm worrying about inverted yield curves because the US just shaved 40 basis points off the 2s10s Treasury curve in the space of about a month. And it's all because the front end of the yield curve rose, because the Fed talked it up. If you go back to 1979, 1982, when the Fed was seriously fighting inflation, so we'll go back to the idea that inflation is going to be around for a lot longer than we thought. There's wage inflation, who knows? But when you go back to that time, the 2s10s yield curve inverted by 250 basis points, and then inverted about a year later by 150 basis points or something like that. The point is, it could be very volatile.
Right, but that situation is not the
That
current
is
situation.
the potential current situation, because the 10-year 2s10s steepened to 140 basis points just about 3 or 4 months ago. And since that period of time, since the summer, has flattened and flattened. So, a lot of the assumptions built into budgets by financial institutions across the US is based on the idea of a steepening yield curve where the Fed raises rates. That did happen, but not during 79 to 82. In 79 to 82, the yield curve inverted. So, and big time, and not gradually, but quickly. So we might be in for those times.
I think what you're suggesting is a supply shock today is similar to the supply shock of yesteryear. Is that what you're suggesting?
Or the Fed's response to the supply shock inflation numbers that they were seeing.
Okay.
It could be very similar to the playbook that we saw, and they can accomplish it even without raising rates by just letting the front end of their yield curve of their SOMA portfolio run off and push up the front end even further. If they start quantitative tightening and half their SOMA portfolios under 5 years, guess what's going to happen?
But this is more than likely to be managed much more slowly, you don't think?
I think that they plan on doing that. But again, they also didn't plan on raising rates in 2023. So I don't know what they really think they know or where they're going to be. And I think that's where the market's mindset is as well.
Yeah.
There's a lot of uncertainty right now, a lot of volatility in the market because of, I just don't know.
Right.
The good news is I think that means we're going to see a lot of activity. A lot of people are going to make decisions when there's a lot of volatility. So it's good for markets, good for business.
Good for the VIX.
Well, of course. Well, that's a good thing. We like the VIX. VIX is good for the market.
Okay, no comment there. Okay, I think this wraps it up.
All right. Well, it was good talking to you, Joan. We should do this again.
Thank you all. Thanks for listening. Have a great day. Reach out to us if we can help you out.
Bye, everyone.
Bye.